Welcome to this special conversation on Business Redefined. Forgive me today, my voice is raspy. We are getting better. But nonetheless, the earnings season for the banking sector is here, and Absa Bank is the first kid on the block. We're privileged to have the man in charge, Abdi Mohammed. Karibu sana.
Asante, Julian. It's good to be back here.
Ashkuru.
Thank you.
Abdi, congrats on the numbers.
Thank you.
How was F25 for you? The dividend is up. Of course, your bottom line is up. A bit of sag on your top line,
Yes,
but characterize it for us.
Yeah, look, as you say, double-digit growth at PAT level, always a good thing, driven to a large extent by cost excellence, cost efficiency, some good work on impairment, flattish revenue line, and we'll come to that. But overall, a good set of results for 2025. On the shareholder side, dividend payout up 17% year on year. The share valuation up 37%.
The capital gain is insane.
Yeah, so
Yes.
And really looking at double market cap in a period of about 4 years. Really proud of that journey as well. So I would say the shareholder and the investor today received the news positively. A lot of good work on new business and new income streams, many of them in high double digit, some of them getting the rankings of first, second or third. Bank assurance, the most profitable bank assurance business in the entire industry. The asset management business now top 3, only 3 years in. Custody, north of 70 billion under management in year 2. So a lot of good signs around strategic execution for new businesses and new income streams. But of course, the big story on the revenue line is really the CBR and the direction of travel there, and ensuring that that benefit of about 400 bips goes to the customers, and that has also shown up in the numbers as well. Of course, the other side of that coin is the expected increase in volumes over time that then ensures we start replacing that NII as we move forward.
Okay. As you said, a very fantastic diversification story here, especially for those of us who have covered the evolution of it.
Yeah.
This market is undergoing an overhaul of the risk-based pricing model from bank-specific base rates to an industry shared, either CBR or Kesonia. 2 things there. How is it going for you? 2, we've seen banks leaning more towards CBR. Why is that the case?
Look, I think the reality is that it's more of an implementation and logistics decisioning that's happening across the industry. It is good that the central bank gave us both options because of the implementation of the corridor framework by the CBK. The 2 are actually not too far apart at present. They are operating within a very narrow corridor. But the Kesonia has some more implementation details around the daily updates, the look backs, and ensuring that it's implemented properly and to the correct detail. And I think the decision we took, and I suspect that's the thinking in other banks as well, is that the CBR is currently a lot more straightforward. And given the implementation timelines, let's ensure that we implement that and we comply. But there are a few banks that have gone Kesonia as well. And in some cases, it's a mix of the 2 for different portfolios. In terms of the implementation itself, the timelines have come and gone. We have implemented it. The objective of the entire framework is really to create transparency, to create standardization, and to ensure that customers are able to compare on a like-for-like basis, something which we didn't have over the years as banks published unique base rates for different banks. So we've complied, it's in place, certainly from an Absa perspective, but we've seen the communication from the industry as well. It looks like we've all moved in that direction. The expectation is that it improves transmission, and certainly for us, as you see in the numbers, that transmission is happening. And yeah, we'll continue to monitor, to learn, and to improve as we comply with it.
Abdi, let's talk about, excuse me, credit risk in the market. And credit risk is of interest because we have seen from CBK data a bit of improvement on the NPL ratio, but Kenyans will still tell you, we hear very good macro stories. At a micro level, we cannot relate. How do you see it from your lens?
The way I look at credit risk is there is aspects of it that are directly related to the pricing conversation. You know, if it's more affordable, the risk does indeed go down. And we've seen both in terms of impairment and the new flows into default, as well as the existing NPLs and how that trajectory is going, that price does indeed have an impact on those numbers. But there are aspects of credit risk that are independent of that, that relate to sectors and what each sector is going through. We've had, payments and payment delays and what happens in that space. We've had specific concerns over the last few years on manufacturing as a sector. We see that improving, but it's independent of that pricing conversation. There is also a size issue. So you see in the corporate bank and the larger institutions a better experience. And the further down you come into SMEs and more, informal businesses, the risk factor still does exist. And we continue to work on it through capacity building, helping customers, and so on. So there are aspects of credit risk that need to be addressed on their own, separately from the pricing conversation. We see improvements come through, but in certain sectors, as you say, there are issues. And we see it especially in some of the SME sectors that we deal with. There's still some work to be done, in that space.
And as you talk about the SMEs, and given how in the recent past we've seen Absa Bank really whetting its appetite for that segment of the market, how then do you protect your credit risk there?
First of all, the empowerment and supporting customers through, how they run their own business, through financial training. And we shared some of the numbers this morning, 40,000 SMEs trained, capacity developed. That is part of it. The other part is just product appropriateness, ensuring that the right solutions are offered. Often, sometimes, default happens because of the suitability of the actual product and solution. So ensuring we are doing that. On the back end, partnerships with, guarantee funds. And one of our biggest for us is the Africa Guarantee Fund. We've done some work with others as well. Some are specific to certain sectors, agriculture, for example, where you have, sector-specific guarantees. Some are specific to diversity and gender, and we've had a few guarantees that are specific to women-led SMEs, for example. Some are specific to certain sustainability agenda, for example, entities that are focused on clean energy, etc. But ensuring that we have the right risk-sharing guarantees and working with these partners is another important piece of it as well. So it's a combination of actions. And today, when you look at our business banking, where our SME portfolio sits, the loss rates are actually quite low. And we are seeing that improvement come through. Yeah.
That's commendable.
Yeah.
And how is the throughput on Timiza going?
Timiza is going well. We've 30 billion of throughput in the year 2025. It's a high churn book, as you know, and therefore it doesn't stand still. But 30 billion going through there, manageable risk rates, good client data that we are able to use to suggest new products. And we feel with Timiza that we now have a good chassis on which we can scale. So we have maybe 150, 200,000 customers there, but there is a bigger database of customers that have self-created on the platform that have not yet transacted. And we believe we can now scale with what we have to that population. So that's going quite well. Yeah, that's going quite well.
Wonderful. One of the issues which the International Monetary Fund flagged when they were last in Nairobi, I think in December, was what they called the sovereign bank nexus and banking sector exposure to government debt. How does Absa see it? How is that evolving?
Look, first of all, we like the trajectory of travel with regards to the issue of debt, generally the fiscals and how they are, panning out, the terming out of the debt and, the refis that have been done over the last 2 years, starting with the big one, the Eurobond.
June 24.
Yes, indeed.
Yes.
And the most recent ones addressing the upcoming debt. So we feel that trajectory and that direction of travel is quite good. Of course, in terms of our exposure, both to govies as well as directly through public sector transactions, that continues to be an important part of the business that we do. But the desire also is to continue increasing our private sector lending and ensuring that we are pivoting more in that direction. So it's a combination of the two. The sovereign, as you know, has got some upgrades in the January timeline. Moody's also coming online and raising pretty much the same things: liquidity management, debt management, the fiscal direction of travel as things that they are comfortable with, and of course raising some of the ongoing issues and the potential shocks that could come and how to deal with that as well. So it's a good direction of travel with some balance into it as well. Yeah.
Abdi, you ensured you matched your 1% growth in your assets with 1% growth in liabilities. You must have been very cautious about your cost of funds.
Look, 2025 was a bit of a reset year when it comes to the entire pricing mechanism, with the change in the framework, with the drop on the asset side of the portfolio. And so cost of funds was a big part of the journey and a big part of what we were doing. And therefore, a lot of decisions were made in that regard that ensures that the liability book is also profitable and is handled, correctly. At the end of the day, it's about the NIMs and the margins and ensuring that while we pass the entire benefit on the lending side, we ensure that as a bank, we are also balancing it off with what we do from a shareholder perspective and ensuring the liability side is well managed. So there was a bit of that. Of course, the mix between, what we call CASA and the deposit side was a big part of the conversation. And you will see, because of the work we've done on the digital front, that CASA is going up. And that's always a good sign. It's driven our NFI picture, which you saw is 12% up. And in a way, reducing the dependency over time on the NII side of the book. Yeah.
And in that case, you're talking about the transactional deposits, which then help you cushion the pressure there. I would have loved to continue, but my voice is constraining me. Let's wind this down. Tech and banking. Yeah. So much talk about AI. What are you guys doing?
Look, AI is its utility now. It's part of what is available. The idea for us is really to look at what are the use cases and areas where it's commercially viable. And where it becomes a big part of the strategic drive that we have. So the use cases include, on the lending side, using AI-supported infrastructure that allows you to make better decisions, using AI for customer service in terms of basic queries and things that can be done in that regard, using AI internally for our own training and staff, training our staff on policies, procedures, and things within the bank. Using AI combined with data for managing cyber risk and fraud-related items. So there are many core use cases that we think viable commercially that are important. And so within that wider AI utility that exists, it's really about being targeted about what you want to do, how you want to use it for the business, and how you want to use it to grow. So it's quite topical, both in our exco as well as our board. Our board is very interested in AI, and we've had many engaging conversations about where we can use AI to drive the business forward.
Final question, Abdi. Yeah. You've seen the developments in the Middle East. How do you see them? How do you see a spillover here?
Look, I mean, it's as we said, it's a developing macro event. It's a few days old. We continue as a group, not just here, to monitor how that pans out, what it means from a supply chain perspective, what it means from a commodities pricing perspective, fuel, etc. You can never predict the timeline of such an event. All you can do is build the right scenarios within your business to ensure that you have the strategic flexibility to be able to deal with the outcomes, and also how you prepare yourself to work with your customers, depending on the sectors they are in, to work through it, because sectors will experience this differently depending on how it lands. So early days, we are monitoring closely. Our commitment is just to make sure that we work with our customers and stakeholders through it. The hope always is that it's managed well and managed quickly, but we have to prepare for all scenarios and ensure that we are ready from a strategic perspective.
Abdi Mohammed, the man steering Absa Bank in terms of its expansion and how it scales, and you've seen the FY2025 numbers, stellar performance there by the bank. Of course, we would have continued this, but because of my raspy voice, we have to close it there. We shall keep it business defined. Stay tuned.